Attention, investors. If you think the market is safe, think again. Discover how inflation and the Fed's monetary policy can put your wealth at risk. Get ready for a compelling analysis that could change your investment strategy. I was talking about the financial crisis of 2008 before it happened, right on time. And I can say that the crisis coming now is going to be much worse than what happened in 2008. But it will have a different shape and end differently. The cause remains the same: the Federal Reserve and monetary policy. There is also the government's fiscal policy that, even though it's less visible, plays an important role in this complicated scenario. This time, what will matter most in financial markets is inflation. To me, inflation is what everyone needs to consider when crafting an investment strategy, especially one that works well for the next decade. It's essential to see inflation not just as something that affects prices, but to think of it more simply as a kind of tax. Essentially, inflation represents a disguised tax. You need to grasp this because governments have ways to cover their expenses. The most direct way is to levy taxes, and, of course, this is not the most popular choice among taxpayers. No one likes to give money to the government. Politicians, wanting to be re-elected, shy away from explaining how much these public programs really cost. The other way is to borrow money through treasury bonds, for example. When the government does this, it is simply postponing the tax payment. Any money they borrow today needs to be paid back tomorrow. So, where does this money come from to pay off the debts with those who bought the bonds? From future taxpayers. Meanwhile, those paying taxes today are shouldering the interest on the borrowed money. This means that when the government finances its expenses with loans, taxpayers end up paying more because they have to deal with the principal and all the interest. It's like buying a TV. If you pay upfront, it's cheaper than financing with credit and paying the minimum every month. In the end, you could end up spending 2 or 3 times the full price just in interest. It's somewhat like funding government programs with debt. When you go to pay off this debt, you realize that those programs cost much more than if they had been funded with taxes at the time. Now, the government is having to find a new way to finance things because getting borrowed money from private sources is becoming complicated. They can't offer interest rates that are attractive to lenders due to the massive amount of debt they already have. The situation has become so critical with borrowing that the national debt of the US is nearing $30 trillion. Successfully financing this, it's practically impossible, especially with money that has real purchasing power. The debt is so large that even if the government tried to pay a normal interest rate, it would be unfeasible. What they are doing now is financing spending through inflation. The scheme is as follows. The government issues debt, and the Federal Reserve comes in and buys that debt. For this to happen, the Fed needs to increase the money supply. When the government borrows money from a private lender, it's just transferring the debt. It doesn't change the amount of money in circulation because the lender can't spend that money while it's lent out, and the government then uses that money to finance spending. Now, when the Federal Reserve prints new money and buys that debt, it's like injecting new cash into the economy. The government didn't take money from anyone. It just created new capital. When you pay taxes, your money goes from your pocket to the government, which then passes that money on for someone else to spend. In this case, your purchasing power decreases because you're left without that cash. But if the government decides not to raise taxes and just prints more money, your purchasing power, in dollar terms, doesn't fall. The problem is that the person who received that new money will now compete with you for products in the market, driving prices up. So, instead of just taking your money, the government ends up reducing the purchasing power of your money, creating a situation akin to a disguised tax. If you observe what is happening now, especially since the beginning of the pandemic, government debt and money printing are completely out of control. We have never seen anything like this before. About half of what the government is currently spending is being printed by the Federal Reserve, meaning it's not just borrowing and spending, it's printing and spending. And right now, it seems that no one is viewing this as a problem. People believe we have found a financial fountain of youth, which is what they call modern monetary theory. The idea is that we can have everything we want as long as the government prints the money. There are no limits, and it's fine for the government to print money. But why didn't we realize this before? If all we had to do was print money, why have we had to pay taxes all these years? The money printer has existed for centuries. If we could have everything we wanted with the magic of money printing, what would be the point of paying taxes? The truth is that this is an illusion that will end badly. There is a significant difference between earning real money and just having the government print it. When people are productive, they have jobs and are working, helping to increase the supply of goods and services available. You perform a function and, in return, earn money to buy the goods and services that you help produce. The more productive you are, the more you earn, and consequently, the more you can enjoy what society produces. On the other hand, when the government simply prints money and distributes it, this results in many unemployed people at home receiving checks. These people are not producing anything. They are not contributing goods or services to the economy. Yet they can still consume in this way as if they were productive members of society. What happens? Prices start to rise because if you contribute to the production of goods and can consume what you helped create, that's fine. But if you start consuming goods and services without having helped create them, it's just more money chasing a limited supply, which inevitably leads to rising prices. The irony of the situation is that the Federal Reserve is promising more inflation to Americans. This is a promise they will keep, and not in the way most expect. Inflation is not a good thing. In reality, inflation is not desirable. Having higher inflation does not mean we are progressing. What people really want is a lower cost of living. When prices fall, it truly indicates progress, and that's what characterizes a healthy capitalist economy. This is the essence of capitalism. With true capitalism in action, companies become more productive and efficient, achieving economies of scale and reducing production costs. When this happens, demand increases since lower prices allow more people to buy more things. Traditionally, it has been falling prices that have driven up living standards. However, the government has disrupted this positive process due to inflation. Moreover, inflation not only raises prices but often prevents prices from falling. A decrease in prices would be a genuine gift for the consumer. When that opportunity is denied by the government, it is indeed a tax because the government is draining people's purchasing power. As the goods and services they wish to consume become less accessible due to inflation caused by government actions. Since the financial crisis of 2008, much of the inflation created by the government has temporarily manifested in asset prices, stocks, bonds, real estate, and collectibles, among others. When asset prices rise, the usual reaction is not one of complaint since those who own these assets feel wealthier. However, for those who do not own them, like those wanting to buy a house, this situation becomes problematic, especially as prices increase. The government has tried to mitigate this by keeping interest rates artificially low, allowing people to pay more than they should for homes, even amid rising prices. But all this manipulation distorts the economy and fuels the bubble, while consumer prices continue to rise. The last thing the government wants is for the public to realize the real level of inflation. They want to prevent bond investors from understanding that sustaining the bubble economy and massive and sustainable government deficits in the short term depends on these artificially low interest rates. The Fed's justification for keeping rates so low is the absurd idea that we do not have enough inflation. Ultimately, all of this is a big farce as the government tries to justify a risky monetary policy designed to protect its own finances rather than care for the economy or the people. We are about to face the consequences of this inflation in a way that will surpass even the worst predictions. Much of what we are experiencing is connected to what occurred during the pandemic, an event I did not foresee, but that is accelerating everything I have been warning about and making the situation leave. And worse, in response to the pandemic, many thought, oh, this is deflationary, imagining that people would have no demand since they were at home. But in reality, it could lead to an even more intense inflationary scenario. It is true that many people stayed home during the pandemic and did not spend on travel or lodging, but they had no trouble shopping online, especially on Amazon. So, demand did not stop. It simply shifted to other categories of consumption. The government, which produces nothing by itself, relies on the productivity of the private sector. When the private sector is thriving, the government can gather part of that progress. However, when it faces difficulties, like during the pandemic, the correct response would be for the government to shrink and return resources to the private sector, allowing it to adapt and recover. Instead, the response has been the opposite. We increased the government burden, resulting in more debt and money creation hypotheses than ever before, thereby creating an economy that becomes more dependent on debt and money printing. This is a factor that makes inflation imminent. What should be considered is that this inflation acts as a tax. The government is about to drain much of what you have, not just through tax increases, which will undoubtedly occur under the Biden administration. The most obvious tax affecting everyone, especially the poorest and the middle class, is inflation. This will have a direct impact on wages, dramatically devaluing what you earn. For savers, retirees, or those nearing retirement, this is even more concerning. All of your lifetime savings can be wiped out by inflation. Likewise, the value of the dollar will be eroded, and we can already see this happening. Despite the predictions that the dollar has appreciated, the trend suggests that the dollar is heading towards an even greater loss. So, how to invest in an era of inflation? Going back to the first decade of this century, you will find some clues. What was observed between 2000 and 2010, when the Federal Reserve was injecting money into the economy after the dot-com bubble, is illustrative. During this period, the dollar index fell significantly. All prices skyrocketed, and commodities like gold and silver saw substantial increases. Meanwhile, the US stock market not only underperformed, but also lost value. Now, considering that the current scenario could be even more challenging, one might expect prices of goods like precious metals and other commodities to appreciate substantially in this next decade. The scenario suggests that if historical trends repeat, the dollar's value will face a sharp tightening, and investments that were safe during previous inflationary periods may become attractive again. You are right in saying that gains for investors in foreign markets could be even more substantial than those in the first decade of this century. Looking back to the 1970s, when we faced stagflation, it is clear that this combination of economic stagnation and inflation was associated with large increases in commodity prices. Assets like the German mark, the yen, and the Swiss franc tripled in value, while gold skyrocketed from $35 to $850 per ounce, and oil rose dramatically. This happens when the dollar depreciates, and with the current situation, the collapse of the currency could be even more severe. Comparing ourselves to 1980, we notice a radical shift. Back then, we were the largest creditor nation in the world. whereas now we are the largest debtor. We also had trade surpluses instead of the enormous deficits we face today. These factors indicate that the dollar may not only fall but could actually collapse. The next crisis may be a crisis not just of finance but of the dollar itself. Therefore, getting rid of assets denominated in US dollars, especially bonds, is a prudent strategy. Bondholders are likely to suffer the most significant losses as the dollar's value continues to depreciate, impacting future purchasing power. US stocks, which are overvalued, also face vulnerability. Many profits, although in foreign currencies, still heavily depend on the US market, whose earnings are about to be devalued and also impacted by increases in corporate taxes, resulting in lower returns for shareholders. On the other hand, emerging markets and commodity-associated economies have great potential for prosperity. Gold, being a true safe haven and store of value, has constant demand in various industries, ensuring its utility. Unlike more volatile assets like Bitcoin, which is in a bubble and does not offer a true store of value, gold is a tangible and durable investment. For those looking to increase their wealth, gold stocks present significant potential. Some may experience dramatic price increases. It's important to note that investing in these stocks involves higher risk, but the compensating return opportunities are considerable. Undoubtedly, there are no gains without risks, and those willing to face these uncertainties can benefit greatly. Thus, diversifying to include physical gold and shares of gold companies could be a smart strategy in times of economic uncertainty and rising inflation. You raise a crucial point about the Fed's current approach to monetary policy. Indeed, the Fed has been operating with a myopic view, focusing only on past metrics like the Consumer Price Index (CPI), while ignoring warning signs and the true direction of the economy. The ongoing money printing and quantitative easing policies, sustained by the belief that inflation rates are under control, could lead to disastrous consequences. The problem with raising interest rates insufficiently is that it may not only crush the economy, but also fail to effectively control inflation. As inflation becomes an increasing burden, it could further hinder the interaction between consumption and investment. Thus, the recommendation to liquidate assets that are in bubbles, sustained by that cheap money, is valid. With inflation eroding the value of money and bonds becoming an even less safe haven, the financial situation becomes challenging for investors and savers. Inflation is indeed draining purchasing power, and holding cash in traditional accounts becomes untenable. As you highlight, while reported inflation numbers are high, the way they are currently measured may not fully reflect the true impact of inflation on consumers' daily finances. If we used calculation methods consistent with those of the 1980s, the inflation numbers could be even more alarming. Regarding interest rate increases, it is evident that for there to be any significant effect on inflation, rates need to be above the real inflation rate. However, the enormous accumulated debt, the result of previous economic policies, severely limits that adjustment capacity. An increase to levels like 10% is simply unrealistic in the current economic structure. This leaves the economy in a trap, where there is no room to effectively combat inflation without exacerbating the debt crisis. Therefore, the scenario is concerning, and the Fed's actions, if not well calibrated and weighed, may lead to a self-perpetuating inflation.